if we get to the point where inflation begins to moderate, the Fed continues to tighten too much, and then that potentially dips the economy or throws the economy into recession. Is that a potential risk here too?
Sure, but let's be less academic about it. It creates instability, right? Because the Fed is behind the curve. They race to catch up. They are throwing the economy into recession. They race the other direction. And so part of this back and forth you see in the market and the increased volatility market is a direct reflection of a less stable Fed policy.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Markets remain bruised and battered as investors digest the results of last week's Federal Open Market Committee's decision, as well as Chairman Powell's latest guidance. The Fed continues to talk tough about its commitment to fighting inflation. Is it really willing to sacrifice the markets in this pursuit? To discuss this, we welcome back Axel Merk, President and Chief Investment Officer of Merk Investments. Axel is one of the most connected Fed watchers I know, and he just spent time at a closed-door event with a number of the top economic policymakers in the country. I can't wait to hear what he learned there. Axel, thanks so much for taking time out of your day to join us.
Oh, great to be with you, Adam.
All right, my friend. Look, lots of questions for you. I'm super interested for your answers to some of these questions here, given where you've been over the past week. But before I jump into them, let's just pull it up high for a moment and let me ask my standard kickoff question, which is, what is your current assessment of today's global economy and financial markets?
Oh, fantastic. The sky is the limit. Everything looks great.
I didn't think Germans were known for their sarcasm.
Well, I've lived long enough in the US. Now, that's a tough question. How many hours do we have for that? I mean, you put it in the right context, right? I was concerned, but then I attended that session of the Hoover Institution on monetary policy, and I'm glad it was on the ground floor, so I didn't have to jump out of the window and hurt myself. So it's the bearish view. I know the bearish view. What really concerned me was to hear the bullish view, because there were intellectual arguments made as to why everything is just fine. And those concerned me because I didn't buy it. And so before that, I said, well, I'm sure they have their reasons and points. And then obviously the folks who have bullish views are also smart people. But the way I tried to integrate that with my own framework, I was more concerned after that than before.
Okay, so it sounds like given your time in the inner sanctum there, you left actually a little more despondent than you were going in about our future prospects. All right, so let's dig into that here. Let's start with last week's Fed announcement, the FOMC meeting, and Powell coming out and talking to the press. So the FOMC made good on their guidance that they were going to raise the Fed funds rate by 50 basis points. So they did confirm that. And Powell, I think, had one of his more uncomfortable pressers. He got a lot of questions about inflation and whether the Fed was up to the task. So I guess first question for you is, what did you take away from all this? There were a couple of things he said that really caught my attention, but before I see the discussion here, what caught your attention?
Well, if I can rephrase it in medical terminology, and I know you and I are both medical experts, but we're not, obviously, but we know enough about medicine that you don't amputate a leg by starting with a big toe. And that's exactly what the Fed is doing, though, when applied to monetary policy. There is inflation. Inflation is way too high. And what the Fed is pointing to is that, yeah, they're going to hike rates, and over time, everything is going to be fine. They're ultimately still in the transitory camp because even though they have promised now to hike rates until summer of next year, they are behind the curve. And it's a problem. And it's a problem that Larry Summers last week articulated quite well. We have about 2 job openings for each job that's available. And that means you have an overheated job market. And that means you can have a wage spiral, which means you can have significant fallout from inflation. And what Powell said many are believing is that, oh, don't you worry about it because the market has priced in all these rate hikes, and so these pressures will abate. And so the Fed has, in words, moved on from its transitory thing, but not really. They think it's enough that in a year from now, things will be a little bit tighter. And that works in the best case scenario, yes. But if you don't believe that the Fed's forecasting abilities are pristine, that's rather concerning.
Okay, if you don't believe that the Fed's forecasting abilities are pristine, I don't think I can think of any examples in my memory where the Fed has been pristine in any of its forecasts.
Well, not even the Fed. That's the part of the point of this, of course, right? Even the folks at the Fed admit that their forecasting abilities aren't all that great, and so that means what they're arguing is that look at the 2-year yield. The 2-year yield prices in a lot of tightening, and if you look at pre-2008, the rate hiking cycle, there they were gradually raising rates, and yes, the 2-year rate, of course, was pricing some tightening. The key difference to pre-2008 was that inflation wasn't out of control at the time. I mean, there are other issues pre-2008, obviously, but the main thing now is inflation is out of control, and the question is, what does it take to bring inflation back down to normal levels? And the Fed's attitude appears to be you just continue as usual. You give some hawkish talk, and yes, you do a 50 basis point rate hike rather than 25, but you take it in strides, and then monetary policy is done in quarters rather than tick by tick data, and everything is going to be just fine if we're just patient enough.
All right, well, let's talk about this real quick, though, for folks that may not have understood what you said when you said the Fed is behind the curve. We use that term an awful lot. Can you just explain for them what that means?
Well, the big toe cutting analysis is really it, right? You need to get in front of the problem. And take a traffic light situation. When you stop at a traffic light, not everybody stops at the same time. Right? The first car stops and slows down. And then when the light turns green, the first car moves and you're 5 cars back and you say, why the heck isn't the car in front of them moving? And that's kind of inflation, right? Inflation is not like a light switch. It ramps up and then it comes back down, maybe if the right things are done, but not in a straight line. And so when inflation has overshot, you need to get ahead of this. You need to really tackle this thing vigorously in order to contain it. And they have shown that they've missed the boat. They've missed the boat entirely. And by the way, they admitted, oh, we used models that have a look-back period of 20 years. Well, guess what? They didn't have a stagflation environment from the 70s in there or anything like that. And so it was impossible that something could go wrong. And so similarly, when they're behind the curve, inflation is high. And yes, they're hiking rates to slow down the economy a tad. And indeed, financial conditions have tightened a bit. Mortgage rates are higher. But to Larry Summers' point, we have a completely overheated job market. It's not good enough to be okay in a year from now, because in the meantime, a lot of damage is caused in the labor market, and that causes a spiral. It's of course great that people are earning more money, but there's a spillover effect to inflation. And then, by the way, it would be great if productivity were rising, but productivity has been falling. And so that's not a good combination.
Yeah, worst of both worlds, right? More expensive, but less productive. All right, and so this concept of the Fed being behind the curve, it can be dangerous on both ends, right? And what I mean by that is the Fed can be following, the curve. It's hiking, but not at the speed it needs to be hiking at to really make a difference on inflation. And then at some point, inflation can top out and start coming down as the Fed continues hiking, and you get to the point where I think a number of people are afraid it might happen here, which is that if we get to the point where inflation begins to moderate, the Fed continues to tighten too much, and then that potentially dips the economy or throws the economy into recession. Is that a potential risk here too?
Sure, but let's be less academic about it. It creates instability, right? Because the Fed is behind the curve. They race to catch up. They are throwing the economy into recession. They race the other direction. And so part of this back and forth you see in the market and the increased volatility market is a direct reflection of a less stable Fed policy. The Fed is not up to the task, and the market says, yeah, you guys are not up to the task. And then the Fed says, well, of course we're up to the task. And so I mean, obviously the lack of volatility we had in the market was artificial. We've taken the lid off the pressure cooker. Some steam is coming out, but there is if the Fed doesn't pursue a policy that's prudent in the long run, you're just asking for less stability in the market, more volatility in the market. Mervyn King, the former governor of the Bank of England, phrased it right. A few years ago, a long time ago, we used to have policy that was such that inflation wouldn't get out of control. Whereas now we have a policy that because there's confidence in central banks, we can get away with what we do. And that's, of course, inherently unstable. And and if you look at the markets, right, some people say, oh, the market has lost confidence in the Fed. Well, not quite, right? If you look at long-term inflation expectations, nobody knows what inflation will be in 10 years. But what it means is that the market, not you or I or others, think that there is still reasonable confidence in the Fed is going to get it done, simply because of the historic ability of the Fed to contain at least the inflation metrics that we're looking at. Yet even those metrics have been moving higher. And so the question is that just a fluke? Is that just temporary? And the attitude of the Fed appears to be that it is. And I think that the risk of that assessment being wrong is rather high.
All right. Well, that's super interesting and good analogy you made. We think of our just-in-time manufacturing system. It's highly efficient. It was effective, and it worked great for us, right up until the point where it didn't. Right, highly efficient and effective, but not resilient at all. And that's what all these supply chain breakdowns from the pandemic have shown us.
Let's talk about that just a little bit, if I may.
Okay, but real quick, let me finish the analogy so you can react to it all. The analogy is your sort of confidence in the Fed-based system, to me, strikes me as similar, which is it works great right up until the time that it doesn't, right? It's great as long as everybody believes, but once doubt begins to creep in, it's very unresilient and begins to fall apart.
Yeah, the point I was trying to make, not to take away from your analogy, is that
from my brilliance,
from your brilliance, exactly, is that of course what's happening in the real world is not exactly encouraging, right? We have supply chain issues coming out of China. We have a war in Ukraine. We presumably going to get famine because 30% of the wheat supply in the world has been taken off. All of that, and of course you can argue, well, that's a problem somewhere in the world that doesn't have a spillover effect to the US. But the risk of spillover effects, so any of that, less geopolitical stability, is all very high. And what it is globalization going in reverse, which is inflationary, right? It's great that we are onshoring certain things. But when we move away from just-in-time production, that's a higher cost of doing business.
Right, things get more expensive.
Yeah, and then you can see, I mean, my dog 100% agrees with that if you hear barking in the background.
All right, well, look, so on that point, it was interesting during Powell's press conference. I actually tweeted this because I was shocked in kind of a pleasant way, which is, he was asked about these supply chain pressures that are pushing prices up. And he basically said, that's out of our hands. He said, look, we can focus on the demand side, and that's what we're doing. We're committed to getting demand under control. Supply stuff, Fed's really, we're kind of ineffectual there. We don't really have any.
Yes,
it's totally true. I just was surprised he admitted it.
But the key thing is, why do you press the pedal to the metal when you have a bottleneck on the supply side? Right, you have a bottleneck on the supply side, you get a fiscal helicopter drop, and then you press the pedal to the metal. If you can't control supply, which is absolutely correct, why the hell do you go full speed? And you just exacerbate the problems that come with that.
When you're talking about full speed, you're referring to the stimulus that was pumped out for much of 2021, late 2020, right?
Yes, but on the monetary side, obviously, as well, right? And by the way, we still have accommodative policy and we said we'll talk a little bit about the conference, right? There are a bunch of academics and they talk about the neutral rate and whatnot. But the point is, even if where we are right now, we are still on the accommodative side.
Right, we still haven't started tightening.
Well, we've started tightening, and the thing that got me jump out of the window is that the first of all, that crowd that it meets is a very hawkish one. It's known for that, but it's all the more interesting to see the back and forth with the doves that do come. And the dovish argument is that because the market is pricing in tightening within 2 years, everything is fine. And that's really that trajectory on the tightening path is what gets us to be okay. And that's not good enough, right? It's not good enough when there's a hot labor market today. So you have to be able to get in front of that problem. It's only good enough in the best case scenario if indeed all the stuff why the prices were high were temporary. But it's not, right? And some of it is, right? Used car prices may come back down to earth. Sure, that may well happen. But the sort of unstable dynamics we've unleashed in the labor market is not just going to cure itself. And there are plenty of other potential problems that we have, and we just don't have the luxury of saying, oh yeah, well, if indeed there is a problem, then we can always do more. That's and there you see that Powell is a lawyer who just he kind of looks at the opinions presented to him and says, yeah, this model that shows that in 12, 20 years, nothing would have been a problem. That means we're not going to have a problem tomorrow.
All right. Well, let's really now dig into this. So you were at this event at the Stanford Hoover Institute. It had big heavy hitters like a former US Treasury Secretary and Director of the National Economic Council, Larry Summers. It had James Bullard, who's the president of the St. Louis Fed. Kevin Warsh, a former Fed governor, was there. Condoleezza Rice was there. You can share the other big names that were there if you want. But basically, it was big heavy hitters. Summers, I was reading through some of your tweets, and maybe we can talk about it. You know, it sounds like he had a lot of opinions. And to his credit, I think he was out there warning when the stimulus was beginning to get issued, saying, "Hey, this is going to come back to us as inflation." But to your point on the job market, if I read this right, sounds like he says to get back to pre-pandemic job vacancy and quit rates, we'd need a Fed funds rate of around 7% right now, which would be, I mean, it's hard to imagine how catastrophic that would feel to a lot of people.
I mean, of course, some of these things they're thrown out are rhetoric more than anything else. But yes, he means that. It is unprecedented to have that hot a job market, and you don't need to be a rocket scientist or a PhD economist to realize that is a problem, right? You need to cool down this economic growth. And Larry Summers goes as far as saying you need a complete regime shift. And as a starting point, they need to throw out that stupid or idiotic backward-looking inflation targeting, average inflation targeting that they're using. He didn't use these words, but in essence, that's what he said. Later, by the way, there was somebody else arguing that, well, if you look at the average inflation targeting and take every word by word of the new framework that they have, it is so unspecific that yes, you could get along with that and endorse it. I'm trying to think whether that was Jim Bullard who said that, but he said, oh, there's and of course one of the big problems of that model is what's an average of an unspecified number, right? They don't tell you where they want to be, and they say, oh, we'll be on average, we'll be there. And so all of that is a bit odd. But yes, Larry Summers, he is, for those of your viewers who don't know it, he's obviously historically associated with the Democrats, historically more on the dovish side. And he came out when the fiscal stimulus was announced and said, this is highly inflationary, and had this big debate with Krugman, who said, nah, don't worry, nothing bad is going to happen. And so he's been out up front, being very unpopular to his traditional constituents, and spoken up. And because it's not rocket science. And by the way, John Taylor, after whom the Taylor rule is invented, he showed a chart of, you've had him on, John Hausman, and saying this isn't rocket science, right? The Fed is behind the curve. Bullard, by the way, he showed a chart justifying of where we are. And we know about the CPI, we know about the PCE as inflation indicators. We follow it, but the public is barely aware of it. There's another inflation indicator that takes out even more things that might vary in price. And so based on that model, everything has been fine. except, well, even now, that thing has gone through the roof. And so we are behind the curve. So Jim, and then he tried to justify it. Well, if you look at this model with looking at 2 years, then we are not as badly behind the curve. So it's a, it wasn't exactly encouraging. Let's just put it this way.
No, and reading your Twitter feed, I was struck that multiple people made the same comment as Summers, that, or at least your translation of what they said was the same, which was that regime change was needed to be able to kind of break the inflationary cycle here.
Just on that one. Yeah, so that's the kind of the message that I got. Now, I did talk with another PhD economist who used to be at the Fed offline later, and he wasn't at the conference, so I can talk about that conversation, at least abstractly. And he disagreed with that one. Now, this guy is a very hawkish guy, but he said, no, not necessarily, because there is still confidence in the Fed just based on the market not falling apart entirely. And so from that point of view, it's there's different interpretation. So you could go with the same regime, but back to it, yes, I would think the Fed needs to take this far more seriously.
All right, and just to be clear, when you're saying regime change, what exactly do you mean? Do you mean just clearing out the old people, getting new people in there? Do you mean abandoning the inflation target model? Like, what do you mean?
So Larry Summers, if I understood him correctly, means you've got to get rid of the current model that you have. You got to say that model was crap, and we look at it differently. So that's what he thinks. And others think, no, you just need to be far more assertive and whatnot, right? And doing things. And by the way, Larry Summers does not believe in the Taylor rule. He agreed with just about everything that was said, but he's saying he believes you just need to be assertive. And then, by the way, one very important point that he made that I think is worth sharing is the one thing that both that Volcker and Greenspan had that was in their favor is that Fed speak, to not be so clear in what you say. And he said the Bernanke approach and other approaches, when you're so specific, you're exposed for being wrong all the time, and that hurts your credibility. He said there was nothing more ingenious than there was at the Treasury, right? The strong dollar policy says every answer to every question about where the dollar is, oh, I believe in a strong dollar, rather than being too specific. That for the markets, that's far more helpful, right? And if you think about it, right, what is it that the Fed is doing, right? They set rates, right? And they can do a little bit of interference, but for some reason, the Federal Reserve these days thinks that they're the masters of the universe and can control everything and anything, and then it falls apart when the emperor is naked, right? When you see that they're actually not able to do that.
Right, and as we've talked about a lot in this program before, their tools are pretty crude. We treat them like phenomenal surgeons, but they kind of have a chainsaw. I mean, they can only be so precise.
Yeah, sledgehammer, right? I mean, a chainsaw, you can do some nice things, but yeah, no, it's and there the attitude is as well, right? Fed policy is not based on tick by tick data. It works in quarters, and so we are not in a rush, right? There's a general attitude, oh, we can fix this. Just let's wait a quarter or two, and if we don't win the argument at this Fed meeting, then maybe win it at the next Fed meeting, and that may be okay for normal times. But when the market is telling you that, hey, we think you guys have a little bit of an issue there, playing the super cool, I don't know whether that's necessarily the right approach.
All right. Well, look, Axel, I want to get on to your big news about your new investment vehicle. But before we get there, I want to kind of pull you into this debate that's been had on this channel now for the past couple of weeks for sure, which is the consensus among most of the experts I talk to is that, all right, the Fed's going to keep hiking here until something breaks. And then that's where the consensus sort of splinters. We've got one camp, probably still the majority, that says, I don't care how tough the Fed's talking, they got a glass jaw. As soon as it starts getting really uncomfortable, they're gonna have to pivot and go back to easing. And then there's another camp, smaller, but I think might be growing here, people saying, I think they're just to deal with the inflationary threat here, they are going to have to hike more than a lot of people have been giving them credit for. I don't know. Maybe that's what the market's beginning to wake up to here. I don't know, but do you have an opinion one way or the other here?
Yes, I think they're both somewhat right. Ultimately, the whole point of hiking rates is to quote unquote tighten financial conditions, right? You work through those intermediary channels, and the most obvious one is being mortgage rates going higher. So you want rates to go higher. You want the spreads to widen. You want the spreads of high yield assets, of risk assets to widen. What you don't want is for the wheels to fall off. And one thing that we watch is if you look at Europe, where I think people can relate to it more, the spreads of the PIGS country, the periphery, is widening and has been widening, and that's a good thing. The one thing they don't like is the correlation to change, right? You don't want the flight to safety to the German bonds and the flight out of the Italian debt. That's the sort of breakup euro scenario they don't want. But as long as the spreads are widening, that's a healthy sort of tightening. Now, to the other point though, is it enough, right? That's the million-dollar question, that it may not be enough, right? The big reason why we're not going to 7% is, of course, that they are worried that it would be a complete collapse of the economy. But there we go back to the, like, how do you amputate a leg scenario? The longer you wait, the bigger action you have to take, and you've got to take the tough steps at some point, right? There should have been a rate hike last August, then maybe last December, then maybe an intermeeting rate hike in January. And now we have finally got to be a rate hike, and now we're moving to 50 basis points, right? So the medicine that we have to swallow is getting tougher and tougher to get ahead of the problem. And that goes back to what I said earlier. The Fed is not going to be standing idle as inflation is going to go through the roof. We're going to get instability. They're going to try to do the right thing. And they're probably going to unleash more problems than they're fixing, as long as we have a leadership that thinks they can do this with a piecemeal approach.
Okay. Look, the day that you and I are talking, the markets are continuing, I was going to say, to melt down. I think at this point, we're getting close to that being an appropriate descriptor. S&P is down almost 3% right now. It had a pretty, over the past 3 trading days, I want to say it's down like 7-8% or something like that. I mean, it's making folks really uncomfortable here. Let's put it that way. We also, talking about, tightening to slow things down. We did have a negative GDP print for Q1. Who knows? I mean, at this point, maybe we'll have one for Q2. We don't know. But anyways, it's the instability that you're talking about. We're beginning to see sort of everywhere. So it's going to be interesting to see what happens from here. All right. Well, look, we are already seeing, like I just said, the economy is beginning to slow. Fed is doing everything it can to slow the economy here by trying to diminish demand. Yet inflation is continuing to rage hot right now. So what do you call it when you have stagnant economic growth but high inflation? You call it stagflation. Now, I just read news last week, I believe, that your fund has just come out with a stagflation ETF. Can you tell us more about that?
Yeah, so last week we launched the Merck Stagflation ETF. The ticker is STGF. And as you may recall, a few months ago, the word stagflation, oh my God, maybe you heard it on your channel, but it wasn't something that anybody was allowed to use on mainstream media. Indeed, stagflation came up at that monetary conference I was on Friday several times. And we were sufficiently concerned about stagflation that we decided we might as well do something about it. And so we launched an exchange traded product that invests in the sort of things that might, I say might, because obviously we don't know, that might be helpful if we were to have a stagflationary environment. And that includes oil, gold, real estate, and inflation protected securities. And so what we do is we have a rules-based ETF that we launched, in which, based on a trend following methodology, the weights in oil, gold, and real estate get adjusted, and then the balance is held in TIPS, in the inflation protected securities. Now, it's a fairly simple product. It's a rules-based product, but the idea is that if indeed we have an environment of stagflationary pressures, that at least if history is any precedent, those sort of things might be doing well. Now, compared to everything else that's been moving in the market, it's been doing great. Now, it does follow an index, and that index is tracked back many years now, obviously based on what would be equivalent of a back test, right? There's no guarantee it's going to do well going forward, but still, it's a very simple tool that we believe is helpful to investors, and that's why we put it together.
Well, your timing literally couldn't have been any better for something like this. And it sounds like, as you were saying, the Fed should have gotten busy, end of last year, taking the action that it's finally taking now. Looks like you guys looked and saw that it wasn't and said the world's going to need something like this soon.
We got quite some attention earlier this year when we filed it. Those who monitor these things can see that. We're the first stagflation themed ETF. And it's very straightforward to the point. We priced it at total expense ratio, I think is 45 basis points. And so we priced it aggressively, and it works. It works in the sense that it's tracking the underlying index, and we're thrilled about it. And so if you want to have a look at it, by all means, please give it a look. It's, by the way, one way you can support your listeners is by looking at the sort of things that they do, because that helps us to do our research.
Great. All right. Well, look, watching folks' comments on this channel over the past couple of months, stagflation has been absolutely a growing concern of theirs. So I think folks will definitely be checking this out. Just to hammer it home too, the ticker was STGF, correct?
That's right. And you can just put in Google or Merk Stagflation ETF, or go to our website, merkfunds.com, and then you can learn more about it. Yes.
All right, great. So as we sort of wrap up here, Axel, we jump straight to the ETF, but let's jump back up again for a second. So, all right, we talked about, Fed policy and the likely impacts that it may have. Sounds like you think that there's a decent risk of stagflation, and that's obviously why you created the ETF. But as you look out now to the current environment here in the markets, as you sort of peer into your markets crystal ball, what's your best guess and sort of where you see things headed from here? Are we, we're kind of at a precipice right now in terms of technical support wise, where if the S&P breaks through 4,000, not a lot of support technically for a while beneath that. What do you think? Are we more likely to kind of punch below and things get real interesting, or are we oversold here and due for some sort of bounce? What do you think?
Well, I think instability is the theme that's going to persist. And so I don't have as better crystal ball as anybody else. You can make the argument that, we might get a light recession or a severe one. If you don't have a severe recession, there's no severe market blowout going to happen. But with the Fed not being on the ball, or not, quote unquote, ahead of the curve, a lot of bad things can happen, because the Fed will have to try to catch up, and the Fed, unlike popular wisdom, does not care about the S&P 500. They care about the spreads, the high yield spreads, just like the Europeans care about the PIGS countries, right? And if they tighten enough to cause a problem, yes, we'll get a recession. Then the Fed will have to do a U-turn, and so all of that is pretty ugly. The only thing I can say, hey, fasten your seatbelt, right? Because this can go any which way. As we saw, like the day of the Fed announcement, the market went through the roof. Well, it lasted for 24 hours, and then it fell apart. So that's also why we bring out a tool like the Stagflation ETF, and provide a tool. We don't know whether that's the best thing since sliced bread. We happen to like it. I invest in it, but it provides a sort of tool to try to navigate the waters that are ahead. And of course, if you have the patience and live for 30 years, go ahead and put in the S&P 500. Odds are it's going to recover, right? There will be a new all-time high at some point in your future, nominally at least. And just on that note, maybe one note: if you look at nominal versus real returns for equity markets in the 1970s, where we had a stagflationary period, the equity markets kind of held up, but on a real basis, you lost dramatic amounts of money through the early 80s until it was fought. And so there is, if you're cool with that, that's fine, right? Or maybe you want to hunker down in cash. Well, normally you're not going to lose anything. So I can't give investment advice here. You can choose amongst choices, and none of them are brilliant, right? Because the lottery ticket is not what most people are going to win.
Yeah, and I think that's actually a good way to sort of summarize where we are currently on the timeline. It's like there aren't a lot of great choices here right now. Although I do think to the point you just made, there's enough uncertainty right now, and we're beginning to actually see, the uncertainty move to the downside here, where a lot of the conservative alternatives that were kind of disdained, as the markets were still doing really well, like cash, right, are all of a sudden beginning to look a lot better than they did before, right? Hey, happy just to take the nominal losses, the real losses on my cash, but stay nominally flat rather than take nominal losses in my investment portfolio here, right?
I mean, there is, of course, one positive thing. You could be binge watching a Wealthion channel, right? And what I mean with that, it's only semi-joking. The markets are what they are, right? What you can do is you can adjust your portfolio so that you can sleep with it at night, and then invest in the one thing that you actually have control over, which is in yourself. Invest in your health. Because then you're a fixed income generating machine that is robust. And so you can't avoid that there's a war in Ukraine. You can't avoid that there's less political and geopolitical stability. You can't avoid what the Fed is doing. You can just control what you do yourself, and then try to keep your sanity in all of that. And I thank you for trying to inform viewers on options that are out there and what they can do. But ultimately, when there's craziness in the world, right, you got to try to keep your sanity somehow.
Well, I'm really glad you brought it back to that kind of grounding, because that is absolutely true. I think people spend a lot more time worrying about Fed policy, where the markets are headed, and things they can't control. And when they go in a direction you don't want them to go into, potentially for prolonged periods of time, it can be very corrosive to both your physical and your mental health, which are two things that are totally within our control, right? So, actually, you and I have known each other for a long time. I've seen how you've applied that in both your health, running marathons, what you do with your physical wealth in terms of your homestead and the resilient investments you're making there. And you live in Silicon Valley. I used to live down there near you. My wife is a therapist, and a lot of her clients are still from down there. And what's so interesting is she is just seeing a massive boom in her business right now, because of all the people that are caught up in the emotional angst of what's happening to their portfolios right now. It's big tech area, and tech's just getting taken out to the woodshed right now. And it really is a great reminder to keep the right kind of perspective here, that nothing what's happening in the market right now is worth you losing your sense of self-worth, well-being, putting your marriage at risk, all that type of stuff. So appreciate you grounding it here for folks. All right, look, well, as we wrap up here and try to focus on the things that we can control, we can control our exposure to the markets. And to your point, again, folks, go talk to a financial advisor about this, but figure out what your right exposure should be to the markets given this highly uncertain time. If you don't feel comfortable about how you're currently positioned, obviously doing something safe like moving to cash isn't a bad idea, but get professional guidance in terms of, options that you maybe could consider that you don't have on your plate right now. If you don't have a good person to talk to, go to wealthion.com. We'll connect you with the advisors that we recommend. But more importantly, maybe it's time to take a break from the stock charts when you feel your blood pressure going through the roof, and go out and focus on something that truly matters in this world. Anyways, Axel, whatever happens from here, we'd love to have you back on to kind of help us with the play-by-play on the policy side and how you think the markets are going to react to it. I know it's a super busy time for you, especially with the launch of your new fund. Again, congratulations on that. But thanks so much for giving us so much of your time today.
Well, thank you. And it's great joining you once in a while.
All right. And folks, if you want to see us have Axel back on the program again and other great caliber guests of his like, please continue to support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And Axel, look forward to having you back on the channel here again. Thanks so much for sharing us your insider view from the Hoover Institute, and we'll hopefully see you back on this channel soon.
Talk to you soon.